Have you been debating on whether or not you should open up a Roth IRA or a traditional IRA? Maybe you don't even know what an IRA stands for. Well, today in this Wealth Twins Show podcast episode, we're going to discuss the differences between a Roth IRA and a traditional IRA, give an overview, get you to understand what the limits are, and much more. So, Nicole, let's jump in and give them an overview of what a traditional IRA versus an IRA or Roth IRA actually is.
Okay, so we're going to make this very beginner friendly today, and we're going to explain terms for you, and we're going to try to get as much of your questions answered because we did this video because we did get a lot of comments about it.
Yep.
So that's why we're doing it. So to begin with, an IRA, what does that even stand for? It actually stands for individual retirement accounts. Okay. So with that, this will tell you these type of accounts are meant for retirement purposes. So let's just get that straight off. This is something you use to save for retirement. Now, one of the main differences between a Roth IRA versus a traditional IRA is the money that you're putting into it. Now, when it comes to a Roth IRA, you're putting in after tax money. This money has had taxes collected on it, so you're putting that into your Roth IRA. When it comes to a traditional IRA, this is pre-tax money you're putting into that account, okay? That's one of the major differences when it comes to these two accounts. After tax money being put into it versus pre-tax money being put into it. Now, the reasons why this matters is because how the money is invested, okay? Because these are also investment accounts. Now, when you put money into your Roth IRA, that after tax money, the money that you contribute and the money that you earned on it is going to be tax free money. When it comes to a traditional IRA, the money that you put in it because it is pre tax money, that money is growing in that account, tax deferred, and you will end up getting, you have to pay taxes when you take that money out. And the money that you're getting taxed on, the rate is going to be what your income tax rate is at the time you are withdrawing the money. So that's one of the major differences between these two accounts. Nadia, do you have anything else to say about the some major differences between these two accounts?
Well, there are other major differences, but I just wanted to make it easier for people to understand. When you think about a Roth IRA, I want you to think about tax free and post tax, right? When you're thinking about a traditional IRA, I want you to think tax deferred and pre tax. It's easier to understand. So if you're not paying taxes up front, you're going to pay taxes later on. If you pay taxes up front, you're not going to pay taxes later on. Now, if you're debating on which one might work best for you, you need to understand why this makes a difference. If you
Mhm.
believe that you're going to have a higher tax bracket as you get older, when you start taking money out of these accounts, like when you start taking out the money that your money made on these accounts, and that typically is after 59 and a half, so you don't have any penalties, you're thinking to yourself, are my taxes going to be higher at that age than they are now? If you believe your tax bracket is going to be higher, a Roth IRA may be a better option for you. If you think your taxes are going to be lower at that age, then a traditional IRA probably would work better for you because when you get to pay taxes on the money in that account, when you start to withdraw it, your taxes are going to be lower, or you anticipate that they're going to be lower when you're at that age. So that's the
Okay.
main difference when you're thinking about that.
I want to make sure we have something clear at the beginning, though, that these are not either or accounts.
Exactly.
You can have a traditional IRA and a Roth IRA at the same time. So you can get the tax deferred and also the tax free account at the same time. It's not an either or. You can also have a Roth IRA if you have another retirement account, such as a 401k. These are
Exactly.
separate and you can have both at the same time. So 401k, for those that don't know, is also another tax deferred retirement account. So it's not an either or account. It's another account that you can have set up for retirement purposes. But when it comes to having both a traditional IRA and a Roth IRA, although you can have both, there is a limit to how much you can contribute because there's a limit of, I want to say in 2024, the limit is $7,000, I believe, is how much you can contribute. And when I say contribute, how much you can put into that account every year
Yep.
is $7,000 if you're under the age of 50. If you're over the age of 50, and these are 2024 numbers, okay? So every year the numbers changes. If you're over 50, then the contribution that you could put in is 8,000. They allow you, the government allows you to play catch up. But if you have both of these accounts, you cannot contribute more to the max, if you're over 50, $8,000 as a combo with both accounts. So you can either have a Roth IRA and you can contribute up to 8,000, or we can have both and contribute up to 8,000. If you're under 50, you can have a Roth IRA, contribute up to $7,000 a year, or you can have both a Roth IRA and a traditional IRA and contribute up to 7,000. So that is something I want to make clear right off the bat.
Yeah, it would be great if you could contribute the max to both accounts, but the government is not going to let you do that. They're going to get their money. So either you pick one, put all the money in, or you can split between the two, but you have to have a combine of what the actual limit is. And it just happens to be convenient that the limit for both are the same. Now, if we're talking about limits, let's jump into what are some of the limits that apply to both these accounts, because not only is a contribution a limit, or how much money you can put into this account is a limit, but there's also limits when it comes to when you're going to take the money out and get penalties on it, or limits to when you can actually contribute to the money to these accounts. When
No,
I'm
I would
speaking
say
about,
income limits.
I was
Income
about to
limits
say
would
that
be,
when you can
yeah.
start putting money into these accounts based on how much you're making in that year. Okay. So if we're jumping into income limits, like Nicole said, there are no income limits when it comes to a traditional IRA. You can contribute money to it no matter how much money you make. Okay. The only limit comes to how much money you can actually place in that account. When it comes to a Roth IRA, there is an income limit. Now, it depends if you're single or you're married, but for 2024, I just wrote this down. You can put in the full contribution amount to the Roth IRA if you make under $146,000 as a single person. If you make more than 146,000, but you make less than 161,000 in that year, you can have a partial contribution. Okay, the limits differ from when you are a married couple, and I know Nicole wants to talk about what the limits are when you're a married couple. But if you're a single person, understand you can contribute as much as you want up to that contribution limit of $7,000 if you make under 146,000. But if you make over 146,000 and under 161,000, you can contribute a partial amount. After 161,000, you cannot contribute to a Roth IRA. Now, Nicole, what about married couples?
Now, since the limit has changed, throughout every year, last year was 218,000, but this year it has gone up to 230,000 if you're a married couple and you are filing your taxes together. So if you make under 230,000, you could contribute up to the limit, right? But if you make over that, and you could talk the contribution, which you were saying, the money you could put into that account gets reduced the more you make over the limit. So up to a point afterwards, I think it's maybe 246,000. So don't quote us on these numbers per se, because like I said, it goes every year, the numbers change. And because of that, we're going to actually put a link to the actual IRS official website that's going to give you these income limits, because they do change, but you do want to be able to make sure that you can contribute or not. So just in general, if you're a high income earner, if both of your combined income gets to above over 200,000, say, then you're going to start running into some issues as to how much you can actually contribute to your Roth IRA, because so many benefits when it comes to having these Roth IRAs, because they grow tax free and you can take out the money that you actually contribute tax free. Because of those tax requirements, those tax benefits you get from it, the government, like Nadia says, is going to try to put some limitations on who can put into that account and how much you can put into it. Okay? So just know that if you're making around 200,000 together, 230,000 together as a married couple, then you're going to start running into some problems when it comes to contributions you can make to the Roth IRA.
Now, if we're talking about the money that you put in, let's talk about the money you can pull out. Because, we're using these accounts because the anticipation is we're going to pull this money out to help us in retirement times or possibly earlier. So we covered contributions. Let's talk about withdrawals. Now, when it comes to a Roth IRA, you can take out the money that you actually put in anytime you want. But when it comes to taking out the money that your money earned in that account, there are limitations. You cannot take that money out without having a penalty on it if you take it out before the age of 59 and a half. And on top of that, that account has to have been open at least 5 years.
Yeah.
So for you to not have a penalty, it's probably like a 10% penalty, but you will get hit on the penalty because you have these earnings that you didn't contribute the money into and they're growing like crazy, the government is going to tax that if you take that money out before the age of 59 and a half and before having the account open for 5 years. But you could
Now
take the
there's
money
some
out.
special situations, right?
It's a special
Where
situation, but I just want
like
people to understand they can always take the money out that they put in themselves out of that
yep.
account.
So that's a big thing. Say you were saving up for something and you say, okay, look, I want to put money away for my retirement, and you put in this money has already been taxed, right? You put it away for retirement, but something comes up. The money that Nadia is saying, the money that you have put in, right?
Mhm.
You can take that out without penalty, and you can take it out anytime. It only comes to when you make money on your money. That's the money that the government is caring about. If you take that out too early, you're going to get taxed on. You're going to receive a penalty on it. And right now, the penalty is 10%. But there are some special situations where even if you're under 59 and a half, and you need to withdraw not just what you put in the account, but the money you made on that account, there are some special situations such as the first time home purchase, and you can only take out a certain amount, maybe like $10,000. There's some other, if you become disabled, and it's like a little list, but they're very special situations. And if you qualify for those special situations, you may not be penalized. But to keep it general, assume that if you take that money out, you will have a penalty of 10% on the money that you did not put into that account, the money you made on that account, if you're under the age of 59 and a half.
Now let's talk about when you can withdraw money from the traditional IRA. Now the traditional IRA doesn't matter when you contributed money, you cannot take the money out, either you contributed or earned it without a penalty, especially if you're doing it before 59 and a half, unless there's under special situations. And they have a list of that on the IRS website that you can, these are the times that you're able to take the money out of your traditional IRA and not be hit with that penalty. So now if you're thinking about, we're talking about age now, let's talk about when you can actually start contributing to these accounts. You can contribute to these accounts no matter how old you are, okay? At any age, even if you have an infant, they can start contributing to these accounts. Now, the thing is, there's a caveat with this. When you can actually start contributing. It has nothing to do with age, but it has to do with if you actually earned income. If you earn income, let's say your child was paid in some way. Maybe they were a model in a commercial, they did something, they got paid for pictures, right? And they were a few months old. You can open up a traditional or a Roth IRA for that child because they had earned income. You can also do this for your teenagers. Maybe they got a little summer job, maybe they're babysitting, something like that. They can open up, or you can open up a traditional IRA or a Roth IRA. Now, in my opinion, I would look more towards opening up a Roth IRA for a child because they have the ability to take the contributions out without any tax penalty, right? And they've already paid taxes on it. So it gives them some certainty about how much money is actually there that is at their disposal, minus whatever earnings they have. And if they want to buy a new house or something that falls within the circumstances where you can actually take out money out of that account without penalties, that to me is an account that gives you more flexibility. You may have a different opinion, but the option is open to both for accounts for your children if you're looking to open up a traditional IRA or a Roth IRA. Like I said before, no age requirement. It's just if you earn income, you can open up these accounts.
So with that, I want to say when you say you can open it, that means you don't need your employer to tell you you can open up this account or not. Well, maybe there's some limitations of who can open it up, but you can open up your own Roth IRA or your own traditional IRA accounts.
Yep.
And the way you would do that is by going to a brokerage company such as Fidelity, Charles Schwab, or a couple of the others that I'm not going to get too many of them, but you have to go there to these brokerage companies and you open up an IRA account there. Now, this brings me to another point. When you open up the account and you start putting money into these accounts, remember, these are investment accounts. You cannot just put money in and let the money sit. You actually have to invest the money that you put into these accounts. And you invest that money as if you would any type of brokerage or investment account. You'll be the one picking either funds or stocks that you want to put into that account, or even bonds. You have to be the one to decide what you're going to do with the money that you place in an account, and then what are you going to invest it in, because we've have heard stories of people who think, okay, I open up an IRA, I put money in, everything's all good, right? But no, there's another step. You have to actually invest the money that you're putting in. You have to put that money to work for you. Otherwise, it's basically like a savings account that actually has a limit to how much you can put into the savings account.
Yeah, you touch upon a point. What okay, not only do you have to fund these accounts, you have to invest in something with the money that you're funding these accounts with. But how do you fund these accounts? Well, there's multiple ways that you can fund your IRA. You can do it in one bulk sum and put $7,000 down. You can do it in smaller payments. To me, the easiest way to actually fund these accounts, like a Roth IRA or a traditional IRA, is to do direct deposit. You can get these brokerage companies to actually take the money out of your bank account for you so that you're already self funding these accounts instead of waiting to a point that you're actually the person who has to fund it, right? You want to take yourself out of the equation as much as possible and make it go smoothly. So the easiest way is to do direct deposit, have it pulled out of your bank account, put the money into these accounts, and then take that second step and start investing the money that you actually have in these accounts. Because one of the things that makes a big difference when it comes to investing is being consistent. And you have to be consistent. And the easiest way to be consistent is to take yourself out of the equation when it comes to putting money away for investing purposes, especially when it comes to retirement. So just like your job takes money out of your 401 out of your paycheck for your 401k, have these brokers companies take money out of your paycheck or out of your bank account to start funding these other retirement accounts. So you know at least some money's going in there and you're taking the pressure off of you.
Now, with that, if you're saying that you're saving for retirement, either it's for your child, right? Because anyone can open up as long as you have earned income, or for yourself, right? I think we should let people know that we support IRAs because we believe you're going to need more than just your job's retirement account to
True.
help you build wealth and also help you save for retirement. So and also not just that, it's the way that you can structure, which is not going to be, I'm not going to say this that much in it because it's a beginner friendly video, but the way the withdrawals happen and how you can mix and match your tax deferred account versus your tax-free accounts. There's a way to manipulate that will help you in retirement as well. But the bigger thing that I want to say, the overall thing I'm trying to say with this is that you want more than your job's retirement account to help you save for retirement. So all the vehicles that we have available to us that the government has given us, we should take advantage of that.
Now, we try to keep this video as simple as possible, and I know maybe we use some terms that may not be familiar. Well, to help you with that, we have a thing that we created. It's a free gift for you. It's called our 25 Terms You Must Know. And this is good for any new investors who are kind of wary or kind of overwhelmed when it comes to the terminology in investing. And that's one of the things that stops people from actually investing is the terminology. So if you want, the link will be in the description of this video. Just download that and you can use that. And then if you want, watch this video again, go through it, see if there's some terms you may not have understood the first time, and maybe it'll become clearer to you after reading that document. So Nicole, I know we tried to keep this simple. We could have jumped into how to tax and Roth conversions or anything like that, or IRA conversion. This is simply for beginners.
Yeah. I mean, I just want to get everyone to understand if this is the first time you're watching the Wealth Twins show, we want you to know that this channel is all about financial literacy when it comes to investing, getting out of debt, building wealth, financial independence, all that. So if you like this type of content and you want to see more of it, then if you want to be notified when we make a new video, which we're doing on a weekly basis, then please like this video, subscribe to the channel, and share it with someone you believe can use this and also someone that you care about. So, with that, Nadia, I think we should say we'll see you later and we'll see you in the next video, guys.
See you in the next video.